faithfully conveying value, interpreting great books from around the world. Hello, this is Sally's Book Talk. Today, I'll interpret the book called Pricing the Priceless Child. The subtitle is The Changing Social Value of Children. This book title sounds like a paradox. Since children are priceless, why talk about pricing them? Actually, priceless here refers to the emotional value of children. For parents, children are their precious treasures. So, emotionally speaking, children are priceless. However, raising children involves significant expenses. From this perspective, children do have a price. Children are priced in two extreme phenomena: insurance claims and illegal trafficking. For example, New York state insurance law stipulates that the death insurance payout for children under 4.5 years old cannot exceed $25,000. For children between 4.5 to 14.5 years old, the payout cannot exceed $50,000. Also, in some child trafficking cases cracked by U.S. police, children are often sold by traffickers for $10,000 to $30,000. So, by what standards does society measure the price of children? And why are children assigned a price attribute? The book we're discussing today provides excellent answers to these questions. The author of this book, Viviana Zelizer, is a sociology professor at Princeton University and a prominent contemporary economic sociologist in the U.S. Economic sociology is a discipline that uses sociological methods to study economic phenomena, primarily focusing on the relationship between social culture and economic development. This book is her representative work. In 1985, upon publication, this book won the highest award in American sociology, the C. Wright Mills Award. Besides this book, her representative works include Morals and Markets, The Social Meaning of Money, and The Purchase of Intimacy. The book has 7 chapters. The author extensively researched literature, outlining the change in American children's social value from 1870 to 1930, from economically useful to emotionally priceless, and how this transformation affected the economic market. Next, I'll interpret the main content of the book in 2 parts for you. First, why are children considered useful? Second, how did useful children become priceless? First, let's talk about why children are considered useful. Children are useful, the most direct reason being they can create economic value through labor. For example, child labor in factories. This was the common value positioning of children in American society from the 19th century to the 1930s. Many families had children to increase the household labor force. The author summarizes children from this period as economically useful. So why was child labor so common back then? The author believes it was mainly influenced by 3 factors. First, the permission from traditional moral values. Americans in the 19th century, upholding the beliefs of work and virtue from the 17th and 18th century Puritans, provided work opportunities for children. Newsberg. In many working-class families, parents thought it was perfectly normal to have children leave school to work. Even if they couldn't work outside, they should actively help at home with chores, care for siblings, or do odd jobs to earn money. Middle-class families, although they sent their children to school for education, they also saw children engaging in labor as a virtue, opposing idleness. Under this belief, from the 19th to early 20th century, a flood of child laborers entered the American market. According to the 1900 U.S. Census report, 1 in every 6 children aged 10 to 15 was employed for pay. The total number of child laborers was over 1.7 million, and 10 years later, it reached nearly 2 million. And the author believes actual child labor was higher than the statistics show, because the report didn't include children under 10 or those who helped in factories or fields during spare time. Therefore, moral permission was a necessary prerequisite for child labor entering the market. And market demand for child labor was the driving force pushing it into the workforce. The U.S. saw the emergence of industrial production as early as the late 18th century. But early production methods were relatively crude. Taking the textile industry as an example, machines replaced manual labor as key production tools. Factories didn't need many well-educated or highly skilled workers. Instead, they needed masses of workers for repetitive, mechanical tasks. For factory owners, alert and dexterous children were not only capable of most jobs, but also cheaper. They could gain more profits from child labor. For example, in 1790, the first workers hired by a spinning mill in Rhode Island, USA, were 9 child laborers, aged between 7 and 12 years old. By 1820, child laborers made up 55% of all workers in that spinning mill. A local newspaper called the Niles Register reported as follows: "If we assume there were 200 children aged 7 to 16 before these factories were built, contributing little to the local economy, but now employed, they contribute $13,500 in annual output to this town." This spinning mill's situation wasn't unique. U.S. official estimates show child labor increased by over 1 million between 1870 to 1900, demonstrating how child labor largely met market demands. I Moreover, in working-class families, practical needs determined children's usefulness. Typically, working-class families depended on daily wages. Unemployment, illness, or death of primary earners inevitably devastated family livelihoods. Amid rapid industrial expansion, 19th century working-class families faced growing economic risks. The middle class could buy insurance against uncertainties, but for the working class, combating risks required all family members' efforts. Thus, having children earn wages became their best strategy against uncertainty. For instance, 1880 Philadelphia census data showed children contributed 1/3 of family labor income. In Irish American families, it reached half. In short, influenced by traditions, market needs, and family economics, child labor was normalized. Usefulness defined children's primary value. Driven by this value, even fostering dependent children carried clauses about their usefulness. Dependent children included orphans, those from poor families, or those facing abandonment. These children were typically fostered by social organizations like orphanages, poorhouses, or foundling hospitals. After intake, organizations would first care for them collectively, then seek foster families. In the 19th century, America's child fostering system drew from the colonial era apprenticeship system of the 17th century. And now in summer, back then, poor parents would place children with neighbors, relatives, or even strangers who had trade skills so they could learn a craft. Building on this apprenticeship model, many local governments developed placement contracts for dependent children during the 19th century. These contracts explicitly required adopted children to provide productive labor for foster families. When reaching adulthood, they could leave with some money, livestock, or clothing. And the usefulness of children was reaffirmed in these fostering contracts. This was considered a relatively fair arrangement at the time. To encourage more families to take in dependent children, placement agencies vigorously promoted children's utility. For example, in 1854, the New York Children's Aid Society, organized by Reverend Charles, aimed to send urban poor children to rural families in the Midwest and upstate New York. And, their flyers bluntly promised, "Most boys are quick and active, learning common labor rapidly. Girls handle general housework capably." Through such promotions, increasing numbers of Western farmers responded enthusiastically, willing to take in these dependent children. However, when society only valued children's utility, non-working infants became burdens. Thus emerged baby farmers in the 19th century, typically middle-aged women who fostered infants for profit. If non-laboring infants were burdens, how could baby farmers profit from taking them? Most fostered infants were illegitimate. Taking them eased mothers' guilt while protecting their privacy. This confidentiality came at a price. The mothers had to pay fostering fees. This provided options for those who could afford it. One baby farmer pitched, "I'll care for the child at my home, until finding good placement, but you'll pay $50 once I assume full responsibility. You'll be permanently free from this child. Despite promises of good placements, this rarely happened in reality. Often, they would sell babies on the black market. For example, in 1890, an employee from the New York Society for the Prevention of Cruelty to Children pretended to adopt for a 2-week-old baby. The fosterer initially asked $2, quickly dropped to 50 cents, and eventually offered to give it away free. This showed a buyer's market in infant trafficking. Baby farmers mainly profited from mothers' surrender fees, rarely gaining from placements. Um, oh, Overall, in the 19th century, working capable children easily found foster homes through legal means. Parents, fosterers, and intermediaries bore minimal costs, while mothers abandoning infants paid fees to agencies. Moreover, infants rarely received proper placements.
This stark contrast underscores the importance of children's labor value in the 19th century.
However, by the 1930s, children's economic participation drastically declined. Earlier mentioned 1910 U.S. Census data showed nearly 2 million child laborers under 15. By 1930, it dropped to 670,000. This sharp decline signaled children's exit from the labor force. So where did children's primary value lie then? Compared to useful children, the author defines 20th century children as economically useless but emotionally priceless. Why did such a monumental shift in perception occur? This is the second part of today's discussion. Historically, researchers sought answers in economic factors. There are 3 main theories. First theory: child labor threatened adult workers' positions. At the turn of the 20th century, immigration flooded America with laborers, making cheap child labor adults' main competition. Thus, removing children from workplaces became imperative.
Second theory: industrial capitalism and technology reduced demand for child labor. Factories needed skilled, educated workers.
New inventions like cash registers replaced child jobs, e.g., messenger boys, making education more valuable for the market. The third view argues that changes in children's value result from parents' rational decisions. On one hand, parents realize that the indirect benefits of well-educated children outweigh their contributions to family income, leading them to prefer long-term schooling for their children. On the other hand, if parents feel that economic investment in children won't yield returns, they might simply choose not to have children. At such times, children increasingly become an expensive consumer good. However, the author of this book disagrees with these 3 views. The author believes that the shift in children's social value cannot be simply attributed to economic factors. A more crucial reason is the public sanctification and emotionalization of children's lives. Because if factors like technological development and increased immigration reduced demand for child labor, we couldn't explain why child labor legislation was prolonged and contentious. Therefore, the author argues that the emergence of economically useless but emotionally priceless children in the 20th century resulted from combined cultural and psychological factors. First, let's discuss how emotional pricelessness emerged. In the 18th century, parents faced with the death of young children, especially infants, behaved calmly and restrainedly, often resignedly accepting the fact. But by the late 19th century, regardless of social class, children's deaths became the most painful and unacceptable for parents. But in the process, why did the public's attitude toward children's lives become so emotional? Summarizing, there are mainly 4 reasons. First is the rational investment theory, which posits that persistently high child mortality rates constrained people's emotions. Specifically, due to factors like socioeconomic conditions and medical levels, child mortality was higher in the 17th and 18th centuries. And in such an environment, parents could anticipate that children might die at any time, leading to lower emotional investment. Second is the greater love theory. The greater love theory points out that compared to the 18th century, Parents in the 19th century knew better how to care for children, and changes in upbringing made people more attentive to children's lives and deaths. Oh my. 18th century parents, often due to poverty or lack of time, raised their children in a laissez-faire manner, leading to neglect of health and safety issues. However, influenced by social, economic, and cultural factors, America saw the rise of scientific parenting concepts in the 19th century. For instance, feeding children at scheduled times because it benefits their health. And many mothers chose to spend more time with children to provide emotional bonding, interaction, and physical contact. These approaches made parents recognize the meaning and value of childcare, increasing their focus on children's health and lives. However, the author argues that 19th century children's utility actually intensified parental grief over loss. When young children died, parents suffered not only emotional loss, but also the collapse of their old age security hopes. And in this sense, children's deaths in the 19th century made people more aware of their living value. Beyond this, public attitudes toward children's lives transformed. A fourth crucial reason was 20th century U.S. government policies protecting children's health, which fundamentally established children's lives as sacred. Why is that? In the early 20th century, disease and traffic accidents became two major threats to children's lives. Whoa. For disease control, the government established specialized agencies and medical institutions. And not through government, public collaboration, major infectious diseases like smallpox and diphtheria were effectively controlled. Mortality rates for children under 5 drastically decreased. These policies also propagated the idea that protecting children's lives wasn't just parental duty but societal responsibility. Yet, as health policies succeeded, horse carriages, streetcars, and automobiles became deadlier child killers than diseases. For example, from 1910 to 1913, over 40% of NYC traffic victims were under 15. By 1914, it reached 60%. To prevent traffic deaths, the government implemented 3 measures. First, building playgrounds to give urban children safe spaces.
Second, promoting school safety education and urging parents and communities to improve supervision.
Third, erecting memorials for traffic victims and organizing commemorations. The first 2 measures are not hard to understand. So what's the purpose of building monuments and organizing commemorative activities? For example, on October 9th, 1922, 15,000 New York children marched down Fifth Avenue and stopped in Central Park. Among them was a special group of 1,054 boys, symbolizing the number of children who died in traffic accidents in New York State in 1921. The New York City Health Commissioner said, "We are here to erect a monument for the martyrs of modern civilization, commemorating those helpless little angels." Bernard Barber, a scholar studying war memorials, believes that commemorative symbols help the public express their stance on the value of the figures and deeds being remembered. In this officially organized memorial event, the monument conveyed the public's moral disgust towards traffic accident perpetrators and sympathy for the martyred children. Therefore, the practice of building monuments and organizing commemorations greatly deepens society's emphasis on the value of children's lives. Driven by these public measures to protect children's lives, children's deaths became a significant social issue. It is not only a tragic misfortune for a small family, but also an issue that deeply evokes social empathy, and even more, a sorrow for the entire nation and society. Through the shift in public attitudes and actions towards children's lives, we can see that children's emotional value has been elevated, endowing children with an irreplaceable attribute emotionally. This perception also promoted legislation regarding child labor. In the early 20th century, people emotionally believed that children's lives were sacred, so having children work for a few dollars a week clearly became an act of desecrating children's lives with money. Thus, some politicians began accusing parents of sending children to work as improper exploitation and attempted to regulate child labor through legislation. However, it wasn't until the 1930s that national child labor laws were formally enacted, such as the National Industrial Recovery Act of 1933 and the Fair Labor Standards Act of 1938. Hmm, uh, Child labor legislation faced numerous difficulties because it sparked widespread debate across all sectors of society. And the focus of the debate was not only whether children should work, but also distinguishing which types of work were legal. Moreover, immediately removing children from labor production meant employers would lose a large amount of cheap labor, while working-class families would also lose a significant source of income. And so, moreover, many argue that if laws declared child labor illegal, wouldn't that deprive children of their right to education through work? And thus, the author states that child labor legislation represented both an economic confrontation, a legal debate, and a profound moral revolution. Now, ultimately, to defend children's irreplaceable life value in public perception, the debate led to laws prohibiting child labor. Simultaneously, influenced by emotion and morality, the law exempted occupations deemed appropriate for children.
For example, household chores, newspaper delivery, or child acting, as such work was considered educational.
Evidently, emotional factors were consistently interwoven throughout the legislative process. Here, the public added another attribute, economic uselessness. Combined with the first attribute, this created the author's concept of economically useless yet emotionally priceless children in the 20th century. But economic uselessness doesn't mean absence of economic value. Emotional pricelessness significantly enhances children's economic worth. This manifests mainly through three-child pricing systems. For instance, as public recognition of children's emotional life value grew in the 19th century, providing decent funerals for deceased children became a universal parental demand.
Yet, working-class families often couldn't afford funeral costs.
The insurance industry keenly noticed this and introduced cheap burial insurance for the working class. For example, in 1895, parents paid about 5 cents weekly. If the child died during coverage, they received $28 for funeral expenses. Since child funerals typically cost $25 then, burial insurance became the insurance industry's hottest product in the late 19th century.
However, this insurance faced significant opposition.
Opponents argued that while understanding parents' desire for proper funerals, compensation felt like admitting a child's life had that monetary value. Thus, whether burial or life insurance for children, opponents viewed it as monetizing children's life value, an unacceptable practice. By the early 20th century, opponents fiercely attacked child insurance in courts and media. Facing such negative criticism, the insurance industry found justification for its legitimacy. Insurance symbolized care for children's lives. Simply put, insurance also acknowledged children's emotional value surpassed economic value. Precisely because of parents' emotional love for children, this expense existed.
Thus, buying insurance for children became an expression of love.
This perspective made opponents realize child insurance could also protect children. As public welfare policies for children improved, child mortality gradually declined. By around 1950, laws removed most restrictions on child insurance. Of course, some necessary limits remained, like age caps and compensation limits. Meanwhile, other child insurance schemes emerged in the 20th century. For example, endowment funds. Parents paid premiums regularly to save for college or marriage, the most popular insurance product. The second system was civil court judgments. In the 20th century, U.S. courts and legal experts struggled most with compensation for children killed in accidents. 19th century courts used an economic formula: projected labor income from death until adulthood minus living expenses.
But in the 20th century, as children's economic value diminished, continuing this standard became unworkable.
The book cites a case: a 12-year-old accident victim in Missouri received only 1 cent in compensation.
Such verdicts sparked widespread public criticism.
Therefore, finding a new pricing standard for economically useless children became crucial. So what was the new standard? Reviewing numerous cases, the author found no clear standard post-20th century. Compensation depended mainly on parents' emotional acceptance. For instance, a judge named Talbot Smith, in a 1956 case involving a 14-year-old boy's accidental death, he approved the parents' requested $15,000 compensation. Actually, such rulings represent the stance of most U.S. courts, denying the past practice of viewing children as labor. Moreover, 20th century court judgments on child death compensation were neither too low nor outrageously high. Because for parents, no amount of compensation can bring back a child's life, but no compensation at all would ignore the perpetrator's responsibility and the parent's emotional loss. Similarly, if parents demand excessively high compensation, it could be seen as exploiting the child's life for profit, like insurance. Therefore, courts consider not only parents' emotional loss, but also the perpetrator's financial situation and the social impact of the ruling. In summary, 20th century U.S. courts define children as emotional assets to parents rather than easily calculable economic assets. The third system is child fostering. In part one, we mentioned that 19th century adoptive families took in unfamiliar children because they needed labor or household help. During this period, physically strong older boys were more popular, but by the 20th century, this labor-based adoption approach became untenable. Facing economically useless but emotionally priceless children, morality and law nearly eliminated all attempts to extract economic value from children. Thus, as children's social value changed, the system for caring for dependent children also evolved. The shift in fostering systems is mainly seen in how 19th century labor homes were gradually replaced by 20th century charity homes. Charity homes are fostering systems where the government or welfare agencies pay subsidies to adoptive families.
Under this fostering system, adoptive parents seek emotional comfort from the children.
Therefore, younger children are more easily adopted, contrasting sharply with the 19th century when infants without labor value were neglected. Since older children are harder to bond with emotionally, agencies struggle to find homes for those over 6. Correspondingly, 19th century baby farmers who profited from handling infants were gradually phased out in the 20th century. However, the black market for babies still existed, with prices rising from $1,000 in 1930 to $5,000 by the late 1940s. By 1951, the price of babies soared to $10,000. Despite continuous price increases, the black market showed a seller's market with high demand. This is because buyers are willing to pay high prices for children to gain family happiness, but few are willing to sell their own children, making babies scarce and expensive commodities in the black market. Thus, changes in the baby black market reflect the fact that children's emotional value surpasses their economic value. That concludes the transformation of the 3 important systems. Simply from their outcomes, society increasingly emphasizes children's emotional value. Meanwhile, in judicial compensation and black market dealings, children's economic prices have also become increasingly high. Perhaps someone might question, isn't this children losing economic value, turning them into another kind of commodity? Of course not! The author believes that in child insurance, compensation for children's deaths, and payments for child fostering, such money holds strong symbolic meaning. We can even say that the economic value of money is somewhat stripped away. Insurance bought by parents for children is never used as a means of profit. Court judgments on compensation for child injuries always revolve around emotional ambiguities. Similarly, families adopting children are not seeking to earn funds from official and welfare agencies, but to gain emotional comfort. In the process of pricing children, emotional value is never absent from start to finish. The author also clearly states that the change in children's social value is a gradual and uneven process. For example, we cannot precisely pinpoint a specific date when children's emotional value was elevated, and there is no clear boundary between their economic and emotional values. Oh, therefore, phenomena like child labor, legislation, child insurance, and legal judgments discussed in this book have temporal overlaps, but this doesn't hinder our understanding of American children's social value. From the 19th to 20th century, the overall transformation process, beyond the economic value reflected in children, perhaps each of us deeply feels that modern society is becoming increasingly commercialized. Um, Things like bodies, organs, and blood, which were once considered beyond monetary value, in modern society, they are still priced as commodities. Thinkers like Karl Marx and Georg Simmel worried precisely about the market's boundary-less invasion into our lives in modern society. However, this book offers a glimmer of hope. The seemingly overwhelming market isn't all-powerful. Money and markets aren't omnipotent. They can be transformed by social, moral, and sacred values. The author uses 20th century child pricing as a test case, demonstrating how money's commodification interacts with values sanctification, proving emotional value cannot be completely erased by economic price in modern society. Additionally, today's priceless children face several social issues.
People question completely abandoning the useful child concept. Priceless children become overly dependent, lack independence, lose family value by not contributing economically, and child rearing hinders parents' careers and self-fulfillment, leading many couples to reject parenthood.
In response, the author believes the U.S. government needs better social policies to support child-related family welfare. Within families, parents should prevent exploitation while fostering children's cooperative participation in the family unit. All right, that concludes our interpretation of Pricing the Priceless Child. Reading notes are below the audio. We'll see you next time.